Good to have you here, Sheila.
Thank you so much.
What stood out to you today from the investor meeting?
Delta's reiterating its targets for 2023 and 2024, but really putting out there that pricing is sticking. Pricing is up 15% over 2019 levels. We assume pricing is flat next year in 2024, but Delta's saying that's sticking. And every 1 point of price is worth $5 to Delta's share price. So having just come back from the Paris Air Show, where aircraft delivery delays are happening, capacity is constrained, we think we're becoming much more bullish on pricing being maintained and airlines being a great way to play this.
So you do believe that they will be successful in holding price the way he seemed to indicate?
Certainly. 15% pricing above 2019 levels this year and next year seems pretty easy to do, especially given Delta's premium customer base, which is growing faster than its mainline business.
At what point do you see a real shift, though, in consumer demand? You said that they believe that prices can be sticky, but traveling is still difficult with the labor shortages. You mentioned the capacity constraints. At what point do consumers just say, you know what, I'm going to drive, or I'm going to sit this summer out in terms of travel? And, of course, you still have a backdrop of consumer that is deteriorating.
Well, I wish I had a driver's license, so I'm definitely getting on a plane myself. But in terms of, I think, there is definitely a shift to services that's sticking for now. And there's simply just very little capacity out there. So if you're going to the Caribbean or if you're going to the Atlantic, which obviously international is opening up in 23 and even further in 24, there's only one way to get there. And so there's probably a bigger pricing opportunity out there. And airlines are trading at 10% plus free cash flow yields, about double what the market's at. So it's a great value opportunity that people didn't believe. But now that we're becoming more comfortable with the economic outlook and capacity remains even more constrained, it's reaffirming that thesis.
What about the argument that what's happening right now in fuel really favors those with the lowest cost structures, right? Is the leverage stronger on some of the discount, let's say the spirits of the world?
We're more in favor of the premium carriers at the moment because of two things. First, we think the U.S. domestic recovery is complete, so we're playing for an international recovery, and Delta's international margins are about half its domestic margins. So as international improves and capacity becomes more efficient there, the margins will also be improved further. So really playing for that, and we think corporate's kind of stagnant here, so the U.S. corporate. So that's why we're playing the more premium carriers that are offering that high-end travel.
You think outbound from China, or we get more trans-Pacific, is that coming?
Outbound from China, you'd play United if you want that, but if you want exposure to the Atlantic, which we're most bullish about, Delta's the carrier to play.
They're targeting at least $4 billion in free cash flow by next year and then beyond. Do you think that's achievable? And what kind of a multiple then do you put on that number?
Sure. So that $4 billion for 2025 plus is a new target that they put out there. One question we have is, why is free cash flow flat in 24 and 25?
Yeah.
You should probably see an acceleration, and that's pretty low. So if you value Delta on its 2025 free cash flow target, it's trading at a 13% free cash flow yield, which is ridiculous. The market's at 5.5. So we could see upside of $100 to Delta shares if they could actually hit their targets, and of course a re-rating. But you assume half of that re-rating happens. It's still a pretty interesting stock.
So if